Good morning, good afternoon, good evening, and welcome to the Bull versus Bear webinar on Monday, the 7th of November. Steve Miley on the call for Trade Day. Welcome, everyone. We're going to go for our usual regular run through in here today, but a slight change. Remember, on the Monday, we take a look at the shape of the week to give us an idea of where the volatility points might come in the week. Yes, we are day trading at Trade Day. However, it is good to have an understanding of how the week might be shaping up. Are the volatile points of the week going to be earlier in the week, later in the week? How is that going to impact potentially what we're doing today? Because if we've got a lot of volatility expected later in the week, it could mean that today's going to be a lower volatility day, maybe not a trend day, maybe more of a range day. So it's good to take a look at, I think, to the shape of the week. Right, let's start off, though, by taking a look at not just the calendar for today, but going forward for the calendar. You know what I'm going to bring up? So this is available. This is the kind of the macroeconomic outlook that I put up in the trading room every single weekend. Well, most weekends. It didn't go up last weekend, actually, but goes up most weekends. And you'll see if we zoom down already to the data table in here. So I pick out kind of when we got significant pieces of data or geopolitical events in here. And what you'll see is that it's fairly quiet. There's not a huge amount going on in there in respect to the number of things. Okay. And I also draw attention to it in here as well. So look, we've got no central bank activity of note. Obviously, we had the Fed and the Bank of England last week. We've got no Bank of Japan, no ECB, none of even the more peripheral central banks, Australia, New Zealand, Canada, Bank of Canada. We haven't got any of those in play this week. So nothing of note with respect to central banks. Overall, the data in here is relatively light and fairly quiet, apart from we've got a massive piece of data. So we do have CPI. So CPI, obviously, with the inflationary pressures that we have around the globe, we have US CPI on Thursday, and that's sandwiched in between both Chinese CPI and German CPI. We also get UK GDP, and with the GDP, with UK teetering at the moment with all the issues that we've had from the UK more recently, that is going to be important as well. But really, the big standout, the big piece of data is US CPI. Now, the other thing, obviously, particularly for my US cousins, you'll know that it's US midterm elections, which is a really big deal as well. So we have those on Tuesday. And then the CPI from the US on Thursday. Those are really the big standout events that we have coming up this week. So it's kind of a light calendar with respect to how much we have, but it's kind of quite a heavy calendar. And we've got kind of two big events, the elections and the US CPI data. Just to note as well, it is US Veterans Day on Friday. So the bond market is closed, the stock market is open, the futures markets are open. So the bond futures are open as far as I'm aware, but the actual bond cash market is closed. It doesn't mean, that doesn't usually, Veterans Day doesn't really have much of an impact on lowering volatility. It's usually almost like a normal trading day in many respects. Although just to point out that the actual cash market, the bond cash market is closed. The stock market, the equity market, the share market is fully open, and as are the futures markets. Okay, and obviously foreign exchange is open all the time anyway. Okay, let's take a look back and a look ahead. So that's what we've got on the look ahead. What happened last week? Well, we know about the Fed. We've picked that to death on Thursday through Friday. Yes, there was the 75 basis point as expected. Slowdown of pace hikes initially signaled, but then Powell, so that was from the statement. So the market took a positive from that, a slowdown of the potential pace of hikes. But Powell then said that the peak in hikes is probably going to be higher than previously expected. So getting there slower, but going higher. And the market overall took that as a risk-off signal. Okay, so higher rates in the long run. But then on Friday, we had the US employment report, which was kind of like a Goldilocks, so it was not too hot, not too cold, just about right, like the porridge. Okay, so we had more jobs added than anticipated. So the NFP, the non-farm payroll element, was kind of showed a stronger labor market than expected, but the unemployment rate was higher than consensus expectations. And that kind of mixed, kind of not too hot, not too cold. The market actually liked that. Okay, so we saw a strong rebound in riskier assets led by stocks on Friday, but still ended up down on the week because of the negativity coming through from the more hawkish Fed. Elsewhere, the Bank of England increased by 75. It was their biggest rate hike for 30 years and the highest levels since 2008. Eurozone inflation was more than expected, came in at 10.7% for October. And then we also had those kind of conflicting back and forth rumors regarding China and the possibility, of moving away from their zero COVID policy. So that saw two-way flow, erratic activity for Chinese stocks, and did have knock-on effects into global stock averages as well, and also into the oil market. So in net, we were down in US stocks and European stocks, Chinese market up and down. US yields initially higher, back close, and actually stayed higher overall, back close to its recent high with the 10-year. The dollar, though, was very erratic. The dollar initially up and then down on Friday, and then gold initially down and then up, doing the reverse as you would expect versus against with the dollar. A massive update on Friday in the end, actually. Huge update for for gold. Oil continued to push higher to multi-week highs, and copper was particularly a good performer as well. So the kind of the dollar weakness that we saw on Friday lending itself to stronger commodity prices overall. So that's what we've got coming up. If we take a look at just today's calendar, as we see in here, right, there's nothing really massive in here. The Chinese trade data we've had overnight in here. It's not showing on this one, but we did have Chinese trade data overnight. Not too much of an impact from that. Let's take a look at 5 things that you need to start your day. Okay, so trouble continued to brew for big tech. Meta, Facebook's parent company, said plans to lay off thousands of workers. So that's obviously a negative. And also, Apple said they're expecting to produce 3 million fewer iPhone 14s than previously expected. Goldman Sachs lowered earnings estimates for S&P 500 for each year until 2024. So a negative there. Nothing really of note coming through in here. Midterms, Treasury expected to rally if Republicans win control of both the House of Representatives and the Senate. Higher prices, higher bond prices, lower yields in here. On the other hand, if Democrats hold the Senate and the House, 39 respondents said the dollar will extend its streak of gains. So what we're, if you're an equity trader, I would suggest what you want is a split, right? You actually want Republicans to win. If you're just doing it if you're an equity bull, if you're not an equity trader, if you're an equity bull, you probably want the Senate to split, because a split Senate is usually good for the stock market. Okay, and that's kind of reflecting in here. It'll also mean bonds higher prices, lower yields. And if we get the Democrats win, it'd be positive for the dollar, because the dollar will be more of a safe haven. So it's kind of a risk. So basically, risk on with Republican splitting the House and splitting Congress, and risk off if the Democrats hold on to the Senate. Okay. And we've got all that to look forward to from Tuesday. US futures slightly up overnight in here. So a few headlines. It's fairly quiet on the macro fundamental front. Not much to add from the end of last week. Equities lead risk off shift as midterm week begins, so focus on that. Chinese officials affirm unswerving strict stance on COVID. So again, bashing down the rumours of the move away from zero COVID. Treasury bikers like GOP, while dollar bulls favour Democrats. So that's just echoing. Basically, risk on for Republicans, risk off if we go with a Democrat win of the Senate. And then a few other articles. US midterms could ripple through the stock market. I'll share this one actually. I haven't gone in through detail, kind of echoing, but I have skip read through that, so that's kind of going to be interesting. So I've shared that in the chat. And here, US futures rise as we go, and then this morning as well, UK faces 50 million, so fiscal hole. We said, so this is, over the wires on Monday, 2 government sources highlighting when a £50 billion shortfall in the public finances needs to be found somewhere, having obviously backtracked previously from those rate cuts. And what have we got this morning? Well, European bourses slightly higher, DAX nearly 1% higher actually, but the CAC only 0.2. The FTSE just very slightly down. If we take a look, having had a strong day up, about 1.5% back on Friday, we're back about another 0.5% higher in here this morning across the Dow, S&P, and Nasdaq, around half a percent up. A quick nod to the Fed Watch tool in here, and we're still pretty much sitting in here around that kind of 50-50. It's been oscillating between 55 and 45, really, between only a 50 basis point hike and a 75 basis point hike at the final meeting of the year on the 14th of December. Slightly, this has just slightly been pushing higher more recently, post the Fed on Wednesday, with now seen as more of a chance of a slowing in the pace of rate hikes, only going with a 50. But as we pointed out, if we go out to like May and June in here, we're now up at 50 to 500 to 525 in sorry, that's May, and then I think 500 and 525. Yeah, so we're kind of, the peak in rates has definitely pushed back higher. Okay, let's take a look at a few of the charts in here. So despite the sell-off that we saw last week, despite the lower weekly close, it was a very strong day on Friday. A follow through on the upside in here. This is the S&P 500. And if we step into the 15-minute chart, I think we do have a base building. It's been a very choppy base. You can see in here. Look at how choppy that was in here. This is through the employment report back here. There's the release of the employment report, down and up again, all the way back down again, and then a firm close on Friday. So very, very, very choppy on Friday, but then a follow through, and we're back sitting right on Friday's peak. So Friday's high there, 88.5. Was that the overnight? No, this is Friday's, right? Yeah, Friday's high. So Friday's high, 805. Oh, no, that's wrong. Excuse me. Yeah, 805.5, and this morning we've been up to 804.5, I think. Yeah, 805. So through there, obviously, opens up upside. If we zoom out a bit in here, is it going to allow me just to drag that? No, of course not. Let me just take off all of this old. And then what we're going to look at is then just from the, I'm going to do both of these. So these kind of sell-offs, I think from the, this was the erratic activity we saw through the Fed. This is the Fed back here from Wednesday. I think really the most important, if we're going to put a Fibonacci on, we're going to take it from, obviously from the low, off that Fed high. Okay. And you can see in here, we're sat right at the 50%. Bang. The failure on Friday was the 50%. The failure this morning is right at the 50%. It's a big deal, I think, if we get back up through 38.05. And then, and for me, I'm playing this from the long side. Where can we get up to? Well, certainly up into this area here. See this area pre-Fed? This area pre-Fed, so somewhere in here, 38.50 to 38.70 kind of zone up to there. The 61.8 comes in around 38.30, okay? But it could be up into here going into today. If we redraw, is it going to allow me to drag that up? I think it will. If we redraw off of the pre-Fed high up there in here, you can see that we're through the 50, but then the 61.8 comes in at 38.15. So that 38.05 to 38.15 is going to be a really important zone in here on the top side, okay? So 05 and then through 15 really opens up a risk up towards like the 65.70 area, I would suggest, going into today. On the downside, if we go in here, really, you're looking at the trend line. So this trend line, it's kind of basic. We don't have a third touch, but suddenly back down. It's quite a way down. 37. I would suggest 37.74 kind of area. You got that little swing low before that in here at 37.86. So 37.86, but that trend line at around 37.74 at the moment, maybe a little below that. Down through there would then make it all look a lot more negative again. Similar outlook if we go and take a look at the, whoops, that's no good. The NASDAQ in here, more damage obviously on the way down, giving back a lot more, almost back down to the lows from the middle of October. But a strong pattern on Friday, nearly a bullish outside day. We didn't quite get above Thursday's high on Friday, nearly a bullish outside day. We've been right back up to Friday's peak this overnight. And again in here, it's basically up through those highs, right? So we've failed right at Friday's high. Friday's high, simple, 974.25. Overnight in here, 972. Again, if I zoom out a little bit, going to get rid of all the old analysis. And if we go in here, let's take the fib off of, first of all, this is the post-Fed. Oops, why is that not worked? Oh, that's no good. No, won't allow me to do that. Bear with me, guys. Sorry. So there's the spike lower. There's the Fed high. And you can see in here flirting with a 38.2. So back above, the overnight and Friday's peak and the overnight peak. And then you've also got that swing high there. That was going to be important as well. So I said about Friday's peak, 974 and a quarter. You got this peak in here so there's the Fed sell-off, and then it kind of bounced post-Fed. And then you got the peak there at 996. Actually, just below 11,000. So 11,000 is going to be an important level as well, up through 11,000. And then if we take this higher, actually to the pre-Fed high, you can see as well, look, just above there, the 38.2 of the whole sell-off from the pre-Fed peak there. The 38.2 is just above 11,000 as well, so it's like 11,010. So that peak, initially we've got the, from Friday's peak, 948 and a half, is that right? No, that's not right. 74 and a quarter, sorry. 974 and a quarter, then 11,000, 11,010. Up through there creates a better bottom. And you've almost got in here, right? It's kind of very convoluted, but it's almost like a head and shoulders, like shoulder here, and this is kind of a very spiky, weird head that we had through payroll. Okay, so shoulder, and then through those peaks in here. So up through basically, say 974, and then up through 11,000 would certainly signal a more bullish outlook for the Nasdaq. On the downside, same trend line. Okay, up off the low through the recent overnight low. That's coming in at the moment. Not that well drawn. That's coming around 10,870, and then the swing low from recent is 899. So basically 900, and then like 870 on the downside signals a shift back to slightly more negative. A quick nod to the commodity markets. Starting off, here's oil. I still think we've got the really strong day back on Friday. Took out that peak from the first part of October, reinforcing this inverse head and shoulders. For me, I could only play this on the long side after Fridays. Yes, we've had a setback, and look, almost perfect in here. See this? This is a Marabuzo candlestick. A Marabuzo candlestick where you basically open at one end and close at the other end. So that's a Marabuzo candlestick. The retracement, the support comes in at the 50% level of that Marabuzo candlestick. So if I just go in now on oil, and we look at the Marabuzo, that's the Marabuzo there. That's the Marabuzo activity, okay, that activity there. And if we go and take a look, let me just double check that is the low so we're not getting the wrong low. The low there was 87.82. So, and then if I go and put a fib on 87.82, yeah, it's off of these lows here, okay. So I'm going to take that from the high to the low, and you want to hold it at 50%. Look, boom, held, bang on. So it went right down this morning, gap down, and it's come right off the right level. Boom, back up. Yes, we've dipped again, but then I would say, you know what? Again, trend line support. We're holding above that. And I think probably was a better trend line in here is maybe that one coming across from just today's activity. This one in here. So watching those on the downside. Back down through these, it looks a little damaged. 91.45, 91.25, certainly below that low there at 90.95. It looks more negative. But at the moment, I would say this looks more positive. It went right down to the 50% of the Marabuzo of Friday's activity and held and rebounded. Gold, what a day. Boom, massive. Look at that. It basically took out nearly 2 weeks of trading in one day. Boom. Took out all these peaks in here. High level consolidation, only a slight dip this morning. Can only play this from the long side, Dip and a rebound, dip in again. I think this current dip's a buy opportunity on gold. Can only play that from the long side from my perspective. All right, guys, I'm going to wrap it up there. Happy Monday. Here we are, another week. I'm going to wish you all a great trading day. Stay safe, and I'll be back with you tomorrow for another Bull versus Bear webinar.